Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
With the election coming up, many people wonder if they should temporarily modify their investment strategy until the results are known. The short answer is no. Trishul and Aaron discuss the emotions that arise from uncertainty. They also go through a decision tree to help clients understand why it makes sense to maintain the same asset allocation they have been using all along. On the other hand, there may be some tax and estate planning opportunities that can develop depending on the outcome of the election. But no need to worry just yet. All of this can wait until after November 3rd. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So, Trishul, I don't know if you have been paying attention to the news, but there is an election coming up. Have you heard of this? It might have come across your radar.
Well, I try to tune out the network news and other sources like that, but it does seep through, so I'm quite aware.
So this is I don't know if it's a phrase for it, but the every 4-year pattern where we have a presidential election coming up. We have a third of the U.S. Senate is rotating every 2 years, and every member of the House of Representatives has to run for re-election every 2 years. But when there's a presidential election, first, we tend to get greater voter turnout. We talked about kind of voting structures last week. But whenever we have the presidential elections coming up, there inherently are questions from clients about, should we do anything before the election in case X happens? Sometimes it's, do we think that markets will go up if one party wins? Will taxes go up if one party wins? But if we're trying to make a prediction on the election, and 538 and other resources do a much better job at those types of predictions, if we're trying to even just guess, if something happens, here's what other things happen, whether it's related to stock market, economy, or taxes. How do you tend to kind of, before you even answer that question with clients, how do you think about that? What's the first thing that comes to mind when you're thinking, should we do anything either in advance or in reaction to presidential elections every 4 years?
Well, the common question that comes up, to be more specific, is should I just go to cash and wait till after the election and go back in?
It's true. That does tend to be the specific question.
Yeah. And, I've already heard it a handful of times, so it's no different this time.
For me, yeah, so I kind of, that's a great kind of intro or theme, because that does tend to reflect the just kind of overwhelming emotions that this uncertainty causes. It's not the uncertainty that we don't know what's going to happen with the markets, could go up or could go down. It's that because it's uncertainty, that going back to like our volatility discussion, that kind of increases fear in clients, which going to cash might help them feel better. One thing I do try to point out is, in general, presidents have less impact on the economy and even less impact on the stock market than they like to think they do. So that's the first thing I try to let clients know, is that if we could predict the election, and even if everything that they said they wanted to do was going to come to fruition immediately because they can get Congress to agree, the impact on your portfolios, whether it's via the stock market, interest rates, or the economy as a whole, is going to be much smaller than you think. There's going to be so many other forces that will impact your investments that, one, trying to predict what those short-term changes are going to be tends to be more random than anything else. Two, we haven't designed your portfolio to kind of look at the next 2 or 3 months. This is a portfolio that we're using for Y number of years. So we're not going to make short-term investment decisions based on this uncertainty, because we have this allocation that's designed for your time frame. And if the time frame is the next year or two, anyways, it is a short-term time frame. We're already in cash. But that tends not to kind of satisfy that feeling of uncertainty that clients have. And so I'm hoping today that you and I can kind of talk about this a little more in depth, of just, where does that feeling of uncertainty come from? Is it unfounded, or is there some merit to it? What does kind of some of the data say? And how can we maybe take action if there is some action to take, or be confident that no, the election specifically isn't what's going to lead us to take action? Does that make sense?
Does make sense, and it probably highlights this overarching theme that we've come to say often, is that, you know, there's only certain things that you can change and certain things that you can understand and predict, and hopefully we can concentrate on the things that are within our control and the things that we can change, and hopefully pull that away from speculation. And the way
our classic serenity prayer.
Yeah, I was hoping I could come up with a better way of saying the serenity prayer without actually saying it, but I pretty much butchered that. So
okay.
let's just put the serenity prayer in the footnotes for this episode as well.
Okay.
But for the markets themselves, you know, a common question again is, should I just stay in cash? You know, just ride this out, and then after the election, I'll go back in. There's too much uncertainty. You know, that's the high level theme. And again, what we always want to note is, long term, the markets go up. Now, maybe the concern is, you know, this preceding period before an election, on average, the markets go down. Now, if that was the case, then, okay, there might be some sort of notion here that we might consider, but I'd encourage us to understand a few things. One, if we actually look at the data, that's not the case. So, for example, from the last 6 elections or so, the market has been up every year for the 6 months preceding the election, including 92, 96, 2000, 2004, 2012 and 2016. Only 1 year was it down, 2008. Now, it's hard to say it was the election that kind of brought it down. A lot more was going on in 2008 besides the election. So on average, you may not even have a notion that's supported by the data that it makes sense to go to cash in all of these events. And what I'd also like to highlight is what happened in 2016, because that was also a year where a lot of people were saying in the news, you may recall this, if Trump gets elected, you know, the sky is going to fall, and we're going to end up, the markets are going to end up in a nightmare situation. There were headlines basically saying that if something like this were to happen, there would be an instant recession, the markets would tank, and basically everybody would be in financial ruin. And the crazy part is the markets went up after Trump got elected. So that night was a night when I was actually trading with my hedge fund. And this was one of the periods where we had also asked ourselves this question of, you know, should we take any sort of exogenous action that would require us to do something different just because there's an election coming up or just because it's election night. And we poured through the data, we looked at all the research, and we kind of aligned that against our models. And frankly, what ended up actually happening is right in line with what might happen if you understand that the markets are completely unpredictable. And that's, of course, Trump got elected. And if you were following the markets as those election results were coming in the night of 2016, that election night, the market actually fell more than 5% in pre-market trading, triggering a circuit breaker and halting trading as all of that unfolded. And then as Trump's election was confirmed, for whatever reason, the sky did not fall. And by the end of the following day, the markets had recovered to be up 1%. And as you might recall, the markets continued to rally throughout the rest of the year. So pretty much everybody maybe didn't get the actual prediction wrong on who might win, but a lot of people did. But beyond that, a lot of people, or almost everybody, got the actual outcome wrong given the correct prediction of Trump winning, meaning the markets didn't tank. The entire economy didn't collapse, and things actually went on and upward. So it's just one of those situations where even if you might understand or have a strong conviction on what an outcome might be in terms of the election, tying that back to what the markets may actually do is even a much more harder question.
So you're kind of trying to simplify, even in the case where people said, if Trump wins, there will be a recession or a big drawdown in the market, that prediction itself, even if they weren't necessarily predicting Trump would win, so that kind of what if prediction ended up being way off anyways. That both the ability to predict Trump would win was off. I think I remember 538 had his highest odds of winning at 30%, something like that. Most other people put the odds much lower. But so the ability to predict what was going to happen was extremely difficult. And then even if you kind of play out those, what happens if Clinton wins, what happens if Trump wins, then the end result also was extremely unpredictable.
Yeah, and if we tie this back to just our basic understanding of efficient markets, it kind of makes sense. For example, if everybody knew that the markets would go down before an election, well, again, if everybody knew this, everybody would sell beforehand, or they would short the market, and it would cause the market to go down in advance of everybody else because everybody's trying this cat and mouse game of trying to get out first. And to be able to be the person in line who actually captures that short is quite impossible because the computers would probably beat us all to it. So it's a game that if it's being played, you're not going to be the one who reaps the benefit of that game.
So we're tying in a few different themes from past discussions, both that kind of efficient market hypothesis. If everyone thinks it's going down, then it'll either go down because everyone thinks it is, or the correct play would be to kind of wait for it to go down and then buy. But even if there was kind of enough strong evidence that it will go down, computers and algorithmic trading will get in first before you can even take action anyways.
Yeah, it's probably easier to understand with something going up, but it also works with something going down. Of course, when something's going up, if everybody thought the election was going up, then yeah, they would quickly buy it before everybody else because they knew it was going to go up. But guess what? It's probably going to go up before you can even figure out the pattern because that pattern is already deciphered by the market.
Okay. Do you have any other historical, I don't want to say precedent, but maybe examples or anecdotes that go beyond just the last kind of computer age, I guess I'd say? I'm trying to, like, the data that I've seen basically says if you get a large enough sample size, that's one of the things to think about is that we just haven't had that many presidential elections within the scope of buying stocks and kind of stock market economy. So we've kind of only had 25 to 30 elections for how long we have data on stock markets and indices. And even one just kind of in terms of sample size, that's not quite large enough to have a good conclusion. But even within that small sample size, it does tend to be a little random. Sometimes the market goes up when Republicans win. Sometimes the market goes up when Democrats win, and vice versa. Sometimes it goes down in response to Democrats winning. Sometimes it goes down in response to Republicans winning. Also depends on what you're trying to measure. Sometimes it goes up in the, say, time between the election and, say, 6 months from that. So it's approximately 3 or 4 months of the actual presidency. Sometimes it goes down in that time frame. But if you go out to, say, their entire first term, then they'll get different results. Sometimes it goes up, sometimes it goes down based on Republican or Democrat. Because we've increased our time frame, it's more likely that it's gone up. Just we see, again, like you said, the markets tend to trend up over longer periods of time. Sometimes you try to factor in, well, they're all running for re-election, so only things that in the first 2 years matter. Sometimes you try to factor in one-term presidents versus two-term presidents, and kind of like everything else, it ends up being more random than we can actually use as a viable predictor.
I tend to agree with that. It's certainly true around this time. You see a lot of newspaper articles and a lot of reports saying there's some sort of pattern relating to historical presidents and some elections, and sometimes, they'll be based upon 8 or 9 data points. And sometimes it might include, the full 25 data points since we have the S&P, but that's still a very small sample set. And if you're trying to discern patterns from just that handful of points, you could if that data was random, but we're not talking about random data here. We're talking about data that's highly correlated to each other. For example, often with 25 elections, you have the same candidate popping up, once, twice, maybe 3 times. You also have periods where the economy is largely similar for, a decade or so, like the 70s or the 2000s and so on. So you're not really going to be able to discern a pattern off of this few amount of information to probably make a prediction with enough significance. And the tricky part is, if that pattern was so obvious with that few data points, that means the pattern would be so great that it would probably be already recognized by now and priced into the market.
Yeah, it's a big factor that as much, again, kind of go back to the efficient market hypothesis, as much as we can glean any predictive ability from any data, it likely has been priced in. I think we do tend to see that in other events over time, where if the thing that's slightly more likely to happen happens, there isn't much change in markets because it's kind of already priced in. And that's why, almost going back to our time frame discussion, if you were, I don't know if you were really scared about the election and you want to take action, you would almost have to take action like 6 months or a year beforehand. I like trying to think like how early things might get priced in, but then we saw in the past 6 to 12 months, COVID and the economy had a much bigger impact on the stock market than anything election related. And if you had gotten out 6 months before the election, so that would have been middle of May or so, you would have missed out on a huge run up in the stock market before that. And it's not to say it's not going to go down moving forward, but that's the other theme I try to discuss with clients, if there's any predictability in the long run. I do think there's some, especially based on valuations. As we get to extremes, like I'm using PE as an oversimplified measure of value, but if prices go up dramatically, we see reversions to the mean, and so we can expect below average returns over the next decade or so. Same if it goes down, we have lower PEs, we expect better reversion to the mean, we can expect better than average returns over the next decade. But how we get to that is basically unpredictable. We don't know if it's going to be flat, muddled, kind of high volatility but low returns. We don't know if there's going to be a big drawdown and then it's going to spend the rest of the decade climbing back up. We don't know if it's going to go up another 20% before falling off. Like trying to predict what that's going to look like in the short term, again, is just too random, and presidential elections are just another thing that is too random to make any viable actions on when it comes to stock markets and investing specifically. Whatever your time frame was and the asset allocation that makes sense for those time frame and goals, if it made sense in 2019, if it made sense going through COVID and through the drawdown back in March and then the subsequent recovery over the next few months, it's going to make sense going through the election. It's going to make sense between election and inauguration. It's going to make sense for 2021 as well. That if you're looking to buy a house in the next year, you have your down payment in cash, leave it in cash. If you're not retiring for 2 decades and you have your 401k all in stocks, leave it all in stocks. Don't change anything based on the election. It's going to be your personal time frame and goals that are going to be the big factor.
Yeah, that's a lot of good insight, Aaron. I certainly agree with what you're saying. At a high level, what it comes down to is this notion of a kind of decision tree. The first question you might ask yourselves is the market efficient or are there irrationalities? Well, I think a strong case can be made for both. We have a strong understanding that the markets do gravitate towards efficiency, but we also understand that the markets can behave irrationally from time to time. There can be this over exuberance or this over gravitation towards fear. But I'd say in either of those cases, it may not make sense to make a tactical decision to move away from the market or jump in or try to time it accordingly. For example, if the markets are efficient, then yeah, that's a simple answer that you can't really outsmart something that's efficient. But if it's irrational, I'd also argue that it's hard to outsmart that either, because just because the market is irrational doesn't mean, you individual investor will know that it's irrational to the point where you should make a play, meaning it's irrational to the point where it's overpriced. And you also have to know when that mispricing will come back to normal. That's a very hard thing to do, even though the markets are irrational. So I'd say in either case, markets efficient or irrational, you're still kind of stuck with the market return, which is a great return to have, by the way. And, if you think the markets are irrational, you're still in a tough game of having to predict when that irrationality exists to the point where you can make a play. And again, I'd say that's very hard to do, if not impossible.
I love that phrasing, that both from the decision tree aspect and how if you go through each of those potential decisions, given certain constructs, you end up at the kind of same conclusion. It reminded me of the John Maynard Keynes quote, "Markets can remain irrational longer than you can remain solvent." That just really to speak to, if markets are irrational, I do think they do behave that way at times. Trying to get any predictability from that is going to be a fool's errand. It's some people will time it right. Some people will get in and out at the right time. but to do that consistently and to predict who will be able to get in and out at the right time in advance is practically impossible, or at least random. That kind of going back to our Wyatt Earp effect, if you just have enough people behaving irrationally, some people will benefit, but that does not make it the smart decision.
Right. And, that timing choice also is very elusive, because sometimes getting out is the easy part. Maybe you timed it right and you got out when things were pretty high, but that getting back in part is a far harder question to play. Often that all clear signal is not going to come, as loudly as that scary signal of you should hit the sidelines and, you've made enough money. Because that top signal is, oh, look, I've made a lot of money, but that bottom signal, it's hard to figure out.
It's so theoretically, if you could say when things are most scary, that things are the scariest you can imagine, that's the right time to get in. And that's not how people are wired to behave. That they don't want to get in at the scary time.
Yeah, that's pretty true. The Buffett quote is essentially be fearful when others are frightened, and be greedy when other people are fearful. Sorry, I messed that up. I'm going to edit this.
I say leave it in. Let's try and get it right.
Oh boy. Anyway, I'll put it in the show notes. But
be greedy when people are fearful, and be cautious or be fearful when people are greedy.
Yeah, exactly.
Okay. So I think you and I both strongly agree that when it comes to investments, one, we can't predict what's going to happen in October, November, December, January, February. We just don't know what's going to happen over that time frame. Whatever the asset allocation is based on financial planning recommendations is going to be what we're going to stick to with clients. The one thing I have seen come out, and it's not quite research per se, but in discussions that I think might have something to it. And I haven't quite formed my thoughts or recommend anything to clients yet, but I want to kind of just talk out loud with you. In 2016, we saw Republican president, Republican Congress, and they were able to pass the Tax Cut and Jobs Act. And this was a lowering of tax brackets on the personal side, also reduced corporate income taxes a decent amount. And it was one of those Republican initiatives that have been one of their goals or priorities for much longer than just this one presidential election, that they've been trying to get this passed for a while. And they finally had the right combination of president and Congress to get it passed. So we saw tax rates come down. Now, part of that was it was automatically defaulted that it will sunset in 2025. And so if there's no other action by Congress that's then signed in law by the president, those rates will go back up. So that was part of, I don't know if it was negotiations or part of the way congressional budgeting works. They do it on 10-year increments. But it did make me think. I started to kind of think about what could taxes look like, especially if the current makeup of Congress and the president stay the same, or it tends to be mixed. Then my guess, again, this is wild guess, my guess is that little major legislation gets passed when it comes to taxes. But if Joe Biden wins presidency, Democrats hold the House of Representatives, and maybe even develop a majority in the Senate, could we see some kind of tax legislation from a Democrat progressive side, like the way we saw from the Republican conservative side based on the 2016 election? And here, again, if we kind of play out decision tree, I haven't checked 538 recently, but my guess is that Republicans are still expected to maintain a majority in the Senate. But if Democrats took the Senate, the House, and the White House, do you think there might be some opportunity to be a little more proactive on the tax side?
Perhaps, yeah. So just to provide a little bit of caveat to the Tax Cuts and Jobs Act that occurred early in the Trump administration, that tax cut, we had mentioned this on a previous episode, that the top 1% received the vast majority of those benefits. Essentially about 20 to 25% of those cuts, according to nonpartisan research, will likely benefit the top 1%. And after a lot of the cuts are reverted, as you had suggested, in 2025, and then for the year following, the top 1% would end up still maintaining their benefits, meaning they'll end up reaping about 83% of the benefits from that law. Whereas most of the people who aren't in the top 1% would lose those benefits. And many of those benefits are part of what might end up on the chopping block should the Democrats take over. The ones that are going to end up being pulled back in 2025, but also some of these that are kind of permanent that may still linger on after 2025, benefiting the top 1%, may also be on the chopping block should the Democrats take over. So there is some understanding that if that does happen, there may be some proactive steps that individuals may want to take. Some of these proactive steps are, kind of in the shorter term, meaning you can only do so much about income and benefits that accrue over a given year. You may be able to push them from 2021 to 2020 slightly. But the main benefits or the main tax cut differences are likely involving things like the state tax and step up in basis. So estate planning is something that is likely impacted, and that's something that may be worth some thought given what might happen in January after the administration changes, if it does change.
So the kind of easy conversation, easy action might be kind of, should you do a Roth conversion in 2020 if tax rates might increase in 2021? And I've tried to point out, I've done a little bit of kind of quick studying on client cases and kind of just samples, and most likely kind of the rates that you're converting at aren't the reason why you're choosing to do a Roth conversion in one year or the other. It's usually your income is significantly lower in that particular year for some reason. That tends to have a much bigger impact. Whereas if you say have retired but you haven't started Social Security, we've talked about this, that's the good time to do a Roth conversion. It kind of doesn't matter if it's at current tax brackets or what the brackets were prior to the Tax Cuts and Jobs Act. And so any benefit there might be marginal at best. It's usually going to be, no, we're spreading out the Roth conversions over multiple years anyways. There might be a super tiny calculation between, like you said, doing more Roth conversion in 2020 than what you were already planning to do in 2021. But it looks like if you were worried about tax rates going up based on a Democratic sweep, and you think, oh, I'll do a Roth conversion at the current rates, your income and all the other items that impact your effective tax rate are going to make the bigger difference. If you have the same salary 2019, 2020, 21, 22, and you're just trying to decide when to do a Roth conversion, any Democratic sweep or tax rate changes aren't going to impact that. You do the Roth conversion in the year that you take 6 months off, whether it's maternity or paternity leave, or you're taking a sabbatical, or you're between jobs. That's the time that you do something like a Roth conversion. It's not going to be in response to a Democratic sweep and potential tax rates changing. It'll be your personal life and your personal income situation that will drive that. Other things, like you said on the estate planning, one thing I keep thinking about, and I have no way of measuring, I have seen other people mention as a possibility, but the step up in basis upon death. I haven't seen anyone give any kind of confidence or probability that it could go away at some point. And I'm still trying to think, is it close enough that it might impact planning, or is it, you know what, we just have to wait and see what happens and wait to see if it actually happens? I was wondering if you had thoughts on that, if you've read anything or have your own personal predictions.
Yeah, so my current understanding is that is part of the Democratic tax proposal to repeal the step up in basis. So just as a quick recap, the step up in basis is the notion that, let's say I'm single and I have 2 kids and I have about $1 million in capital gains on stock that I hold. If I happen to pass away and let's say the day before I pass away, I sell that stock, well, then I would owe taxes on that million, capital gains taxes on the million, let's say 20%. So $200,000. Now, let's say I did not sell that stock the day before I passed away, but I held on to that stock and that stock went to my 2 kids. Well, with the step up in basis, your 2 kids could sell that stock the day after you pass away and pay 0 in tax due to the step up in basis rule. So all of that capital gains gets kind of reset so that an individual from that point on has 0 in capital gains unless there's any additional gains. Now, yes, the notion is that there's more to this than what I just said, but the general notion of step up in basis may be repealed under the Democratic tax proposal. And yeah, that's a pretty big change. So that and the estate tax change, where there is an exemption amount on the amount of money that can be passed from a estate to the heirs, that may also have a change. Now, let me quickly just mention the high-level details on the estate tax and gift tax exemption amounts before we talk about the actual changes. So when you pass away, the total value of your estate is subject to a tax if that value is above this exemption amount. And of course, you can also gift money over your lifetime, but that amount that you gift also gets tacked on to this high-level exemption amount. Currently, if you're single, that exemption amount is around 11 million. If you're married, you kind of double that. And for estates below this exemption amount, you don't pay any estate tax or no estate taxes due after you pass away. But if you are above this exemption amount, let's say you have a $13 million estate, the exemption amount is 11, you pass away, well, 2 million is subject to estate tax if that's the cutoff when you pass away, and the current estate tax amount is 40% of that 2 million, so 800 grand in tax. So it's pretty hefty tax. Mm-hmm. And the notion that we've talked about when we discussed estate planning is that this estate tax exemption amount used to be a lot lower. In the 90s, it was, close to a few million, and then it jumped up to, 4 million, 5 million, 10 million, and so on. And yeah, it went from about 5 to 10 million in this latest rounds of hikes, and now it's kind of adjusted for inflation going forward. And the notion is if the Democrats come back into power, there's a chance that they'll lower that estate tax exemption amount back to around that 5 million-ish cutoff. And if that does happen, that could mean that that estate that's 13 million would only be allowed to kind of stave off 5 million. So, 13 million minus 5 million leaves a hefty tax of about $8 million at 40%. So that's about 3 million in tax versus, that 800,000 I mentioned. So that's a pretty big difference if, a stroke of the pen changes things. And this combined with the changes to the step up in basis could mean pretty large changes for individuals with large estates. So frankly, this is something or an area that I am looking into with my high net worth clients in terms of proactive steps we might take. So there are options here for doing things proactively that could make a big difference in this area.
So in talking to a few CPAs, I am under the impression that if the these kind of combined uniform lifetime exemptions, so it kind of combines the estate and gift taxing, if it comes down, but you've already gifted amounts up to that exemption, that you won't be kind of double taxed. So currently the exemption is $11 million. Let's say you've already given away $10 million, then the state tax exemption comes down to 5 and you pass away. You aren't going to be having a state tax. They aren't going to kind of look back and say, oh no, your estate, you gifted away $10 million and the exemption is 5. They will consider the gifts compared to the exemption at the time. Currently, I believe it's a 3-year look back. I have to double check that. If you try to give away assets before you pass away, with estate tax calculations, they'll do a 3-year look back. If those assets were in your estate within the last 3 years, they will be included for estate tax purposes. So that's why you can't just kind of give it away right before you pass away. They've tried to design the laws, and that's also why it's a uniform lifetime exemption that combines the two systems, to try and specifically defeat any incentive to do that, of just giving it away the day before you died. But I think the action might be, if this starts to become a realistic possibility, like you said, for those high net worth clients that may not have had to worry about estate taxes under the current law, but might have to worry about them if the laws come down, or the exemption comes down based on new laws, that might be the area where they should set up something like a charitable remainder trust or some other irrevocable trust that will allow them to maintain their lifestyle but takes assets out of the estate. Because the assets themselves, upon that gifting, when you fund that charitable remainder trust, and there's a variety of other trusts or instruments or vehicles that you can use to get assets out of the estate but still either provide some kind of lifetime income or other purposes, that might be one of those actions that it might make sense to set those up sooner rather than later. Maybe we could wait until after the election, so it doesn't have to be done in the next month or next couple weeks before the election. But that is something I'm starting to think about when it comes to estate tax and also gift taxing, where if they're going to leave money for children anyways, maybe do that sooner. And then you can set up trusts where you kind of don't just give all the money to kids, but set it up where they have to kind of wait until certain ages. But there are ways to get money out of your estate using the current exemption. When it comes to the step up in basis, I am having a little trouble thinking, is there any actionable recommendation that clients can do, understand that might go away? Can you think of any planning opportunity to mitigate that impact? Or is it just, you know what, you're going to have to pay capital gains taxes now instead of your children getting the benefit? Maybe they just get less of a benefit. I guess maybe donating more things to charity, especially donating the highly appreciated stock. So in this case, if you have that one stock that has $1 million in unrealized gain, but you have other assets that don't have the large unrealized gain, leave the other assets to heirs and donate that stock to charity. That might be a way, but trying to think of other things that might help clients with the idea that we can see the step-up basis going away.
Right. So there's two notions with the step up in basis. One is there is the potential for a step up when you pass away and your assets pass on to your spouse. And then there's another step up known as like a double step up when the assets of both you and your spouse pass on to your heirs. So, well, first of all, it's not clear which of the two step up in basis will go away. It might all go away. We're not quite sure.
It also depends on what state you live in. Because I know a community property estate, you can get that kind of double step up going from one spouse passes away to the spouse surviving, gets a step up in basis. When that second spouse passes away and asks to go to children, they also get a step up in basis. But I know for a separate property estate, the calculation is more complex. Yes.
And so there are opportunities perhaps with also using irrevocable trusts in this case as well to take advantage of changes in the step up in basis. But I'd say if we're crossing this territory with a high net worth individual, I'd say it's always best to probably consult a professional. I'd hate to say that, too often, but this is certainly one of those areas where things get really nitty gritty in terms of what's going on with an individual situation. And there are options out there, certainly, if you're being proactive, but it's going to come down to, like you said, what state you lived in. Are you married? Where does the money plan on going? Is it heirs, or do you have a charity in mind? And also, how creative are you willing to be, and how much flexibility are you willing to give up in exchange for all of that?
That's a good point. It would be so individualized that, and there's going to be so many factors. Trying to give any recommendation on a podcast would be a fool's errand. But
I'd also highlight none of what we say is a recommendation anyway.
That's true. That's true. It's we try to go to those caveats that these are just kind of ideas that may or may not apply to anyone in particular, but this is not advice for any individual.
Right.
Thank you for adding that compliance disclosure in there.
Right.
So I'm trying. Is there anything else that you could think of with a step-in basis? I can see it depending on whether it's spousal or not. I can see. I guess how would using an irrevocable trust or getting assets out of the estate, other than going to a charity, affect the step-up in basis aspect?
This gets really nitty-gritty if we get too deep, but one notion is if you have two sets of assets, one with a higher basis, a lower tax owed, well, those would be more prime for moving them out sooner rather than later to outside of your estate. I'm using air quotes all over the place because, again, this gets very individualized. So I guess just at a high level that there are ways, and it gets pretty complicated, but it's something that you'll want to walk through step by step with a professional if you're going down this road.
Okay. So maybe there might be a reason that things like stocks that are likely to appreciate over time, it might make sense to get those out of the estate so that the growth occurs kind of outside your estate rather than being part of your estate.
Yeah, and if it ends up in a vehicle like a irrevocable trust where, again, you have less control of the assets now, technically they're not yours anymore by definition. These are just specialized vehicles that they have so many different caveats to them in terms of what you can and cannot do that it just gets a little more complicated, and it's probably beyond the scope of the X amount of minutes we have for this podcast episode.
Hiring an attorney for a few hours and probably more than just a few hours to get this part right.
Yeah. It's something, we work through on an individual basis with a client over the course of a few months to get right.
Okay. So as we think of the election coming up, from a kind of financial planner, financial advisor perspective, we kind of agree that when it comes to the investments, there's not really any action to take. There's definitely kind of the emotions are there, that fear and uncertainty is there. So having the conversation, I think, is valuable and worth it. But in the end, it's likely that the asset allocation is going to be the same as it already was. When it comes to taxes, there might be some opportunities, but also sounds like it's not necessarily related to the election per se. We can kind of wait and see the results, and we'll have enough lead time to take those actions, so there's not any urgency there. So if we're going to kind of think about that decision tree aspect, there's nothing you need to do now. The election will impact many other things, but probably not your finances. So don't worry about your finances on election night. If that does you agree with that kind of conclusion? Is there anything else that you want to add?
No, I think you kind of summed it up. At a high level, when it comes to your actual investments and what to do, it's unlikely that you'll be able to outsmart the market. And when it comes to taxes, you can kind of look at your individual situation, and there may be some marginal things that you could do if you're talking about just income. But if you're talking about wealth and estates and passing money on to heirs, then there could be some opportunity if you have 5, 10, 15, 20 million in your estate. And at that point, it's probably worth just a conversation with your tax advisor and your lawyer. But yeah, at a high level, I think just waiting till after the election is not likely going to put you in a horrible position, because at least then you'll have a lot greater idea of which house of cards you're dealing with. And at that point, you could make a more proactive decision on what to do. Okay.
Sounds good. Well, this has been I feel like this is one of those conversations. Every now and then I'll have a conversation of, okay, I'm thinking about this thing. Let's figure it out. And in the end, do nothing. Is that, do you get that feeling sometimes?
Yeah, well, especially when it comes to the market, I can't imagine how many, research papers I've read about how to do X, Y, and Z when it comes to investing. And then the de facto is, okay, given all that, just do nothing.
Yeah.
Buy and hold.
Does feel a lot like that, yeah.
Yeah, so I have a PhD in buy and hold.
I like to tell clients, like, okay, I've considered at least 5 things as possible. I've rejected them, 3 of them pretty quickly. Do you want to go into those 3 things that I rejected already, and just kind of for your own education, even though they have no impact on you? And every now and then I'll get one client who's like, yeah, I'm kind of curious. What are some of those other possibilities? But yeah, just, okay, good talk. Glad we spent not quite an hour on this, but I hope that we can just not worry about things and think about that serenity prayer. It's outside of control, so don't have to worry about it.
Sounds good. Good conversation, Aaron.
Okay, it's good talking to you, Trishul.
All right, thanks everybody for listening. And of course, if you enjoy these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.